A few years ago, you wrote an iconic paper for the CFA Institute. You mentioned an old strategist I used to talk to named Aristotle. Aristotle never saw a bond market with yield up, price down, and the losses that we've seen over the last year and a half. How do bond investors recover given this historic carnage?
The damage clearly has been much more dramatic in the bond market, and in some ways the overvaluation in bonds was much more extreme. We had central banks around the world who kept interest rates nominally extremely low levels, and real yields were low in many countries. Two-thirds of major economies, not the U.S., but two-thirds of major economies had negative real yields. So the damage that we've seen in the bond market, I think it was expected. When we look at government bonds, it's one thing. The damage in the credit markets is something that we've not yet seen fully rolled forward because a lot of those are illiquid securities, and I think we're going to see more damage ahead. But for the average investor who is willing to buy, for example, an individual bond and now can get a 3 or 4% yield, depending upon the maturity they're willing to take on, that is something that is one of the best opportunities in 20 years.